Dear brothers and sisters, we congratulate you on your devotion to aliveness in the foods you eat. We urge you to apply your quest for aliveness to the world beyond your kitchen. With that in mind, we are going to take a look at so-called cryptocurrencies. We'll try to understand what they have come to tell us. Let's learn. On Tuesday, November 28th, the price of digital currency Bitcoin reached $10,000, an increase of over 1,000%, an increase of over 1,000% since the start of the year when it was valued at $900, from $900 to $10,000. But this was nothing. 8 days later, on December 7th, it jumped 40% in 40 hours, surging past $16,000. This brought Bitcoin's year-to-date gain to be 1,560%. People are putting money in simply because they think other people are going to put in money. This is the largest financial bubble in modern economic history. To find something comparable, we will have to go back to the Dutch Tulip Bubble of the 17th century. One of the earliest examples of an asset bubble, the tulip boom occurred in the 17th century when Dutch speculators caught a dose of irrational exuberance over tulip bulbs. They were then new to Europe. Speculators bought and sold bulbs, pushing up prices, while more people rushed into the market after hearing about all the money being made. Over the course of 4 years in Holland, the price of tulips increased 200 times. At the peak of the bubble, a single bulb could sell for 10 times a worker's entire wage over a year. A worker's annual wage. Then in 1 month, the bubble burst and the price dropped to nearly nothing. Tulip Mania was one of the first recorded speculative bubbles. Let's fast forward to the 1929 crash. Now, during the 1920s, the U.S. stock market underwent rapid expansion, reaching its peak in August 1929 after a period of wild speculation. By then, production had already declined and unemployment had risen, leaving stocks greatly in excess of their real value. Among the other causes of the eventual market collapse were low wages, the proliferation of debt, a struggling agricultural sector, and an excess of bank loans that could not be liquidated. Stock markets began to decline in September, and in early October, the fall began. Panic set in, and on October 24th, Black Thursday, a record 12 million shares were traded. On Monday, however, the storm broke anew, and the market went into free fall. Black Monday was followed by Black Tuesday, October 29th, in which the stock prices completely collapsed, and 16 million shares were traded on the New York Stock Exchange in a single day. Billions of dollars were lost, wiping out thousands of investors, and stock tickers ran hours behind because the machinery could not handle the enormous volume of trading. Overall, however, prices continued to drop as the United States slumped into the Great Depression, and by 1932, stocks were worth only about 20% of their value in the summer of 1929. In other words, the values had shrunk to a fifth of what they were a few years before. The stock market crash of 1929 was not the sole cause of the Great Depression, but it did act to accelerate the global economic collapse of which it was also a symptom. By 1933, nearly half of America's banks had failed, and unemployment was approaching 15 million people, or 30% of the workforce. Then let's fast forward again to the year 2000, to basically 17 years ago. The arrival of scores of new internet companies to the stock market, including the New York-based NASDAQ exchange, created a buzz in the late 1990s that led to excessive speculation. Many new firms were able to win huge valuations as public companies, even though they generated little or no profit whatsoever. There was a mania for technological stocks. This had all the ingredients for a roller coaster ride from boom to bust. Glamorous selling products that investors knew little or nothing about. This, combined with avarice and a booming economy, set the stage. Selling at the top of the market in early 2000 triggered panic. Suddenly, the sources of funding for flashy companies that had never made a penny dried up, hastening their decline and the inevitable market crash. Let's fast forward again to 2008. And now we're in the realm of the subprime mortgage crisis. Banks irresponsibly lent to U.S. households who couldn't really afford the mortgages they were being sold. The banks made massive returns by packaging the loans into bonds and then selling them. When the number of households falling into arrears on their mortgages began to rise, investors began to realize the scale of the bad assets pumped into financial markets. This triggered the collapse of the banking system in 2008. The U.S. government responded by using taxpayer dollars to finance multi-trillion-dollar bailouts to Wall Street's biggest banks. Now, the bubbles of old, like the Dutch Tulip Mania, were confined to a single nation of investors. The Bitcoin Delusion is worldwide. Its price keeps surging as new countries come on board. More than a bubble, we are faced with a delirium. When the Tulip Bubble burst, at least they wound up with tulips. With Bitcoin, they will wind up with nothing but ones and zeros. It is tragic to see ordinary people being caught up in the madness. But of course, I know, this time it's different. We're in a new paradigm. Let's go deeper. Bitcoin is but the most egregious expression of the rampant speculation that has come to dominate the global economy. It is but a symptom. Recently, Neil Woodford, described as one of Britain's most high-profile investment fund managers, issued a sharp warning. In an interview with the Financial Times, he said, stock markets around the world were in a bubble that when it burst could be bigger and more dangerous than some of the worst market crashes in history. This is the result of the biggest monetary experiment ever. After the collapse in 2008, the Federal Reserve and other major central banks embarked upon ultra-low interest rates and pumped trillions of dollars into the financial system. They called it quantitative easing. The response of the Fed and other central banks to the collapse of the speculative subprime bubble and the meltdown of the global financial system was first to bail out the banks and investment companies, and then to pump in trillions of dollars and set interest rates at historically low levels. Ultra-low interest rates led to bubbles because borrowing costs were dramatically reduced. Starting in early 2009, the stock market has tripled in value while barely experiencing any pullbacks. Thus, Bitcoin Mania is part of a much larger bubble created by the central bank by resorting in its resort to the printing press to make the financial markets flush with cash. Also, let's not forget the $1.5 trillion student loan bubble. Student loans have grown more than automobile loans, credit card loans, and home equity loans combined since 2003. This as the cost of higher education has skyrocketed and more students have flocked to get degrees. As the financial commentator John Authors noted, stocks look blatantly overvalued, bonds even more so. Art has never fetched such big prices. The Bitcoin bubble is only an absurd appendage to what is already a bubble in everything. When and how this bubble pops is difficult to predict, but one thing is clear. When it does, it will take a substantial chunk of the real economy with it. There might well be a worldwide financial meltdown, bringing with it massive unemployment. And I cannot help but think what a waste it all is. Imagine if but a 10,000th part of the money thrown away on Bitcoin were devoted to making every schoolyard an edible schoolyard and making every public park a permaculture landscape. Imagine Detroit, a garden for the human spirit. Imagine a regenerative agriculture well beyond organic, wherein brothers and sisters, friends and neighbors have a chance to join hands with family farmers in growing the food that they eat. Thank you indeed, brothers and sisters. We would be delighted to hear your comments and suggestions.